Hello, good afternoon, good day, everyone. Good morning, guten Tag, buona tarda, buenas tardes, boa tarde, depending where you are and on which hemisphere. Sound is okay, so let's start. Converting ideas into tips, that's the subject we'll cover today. And it's a topic that might raise some interest, converting ideas directly into tips. So converting ideas into tips. That's basically what we do here in when trading. There is the process is directly from our mental world, directly through a mouse click, and convert it into pips and cash. So there is, unlike in other areas, business areas where certain manufacturing or service process is involved, here we convert directly our own ideas into profit, right? So it sounds simple, but it couldn't be. Otherwise, markets wouldn't exist as such. And that is basically important to have in mind. That such a direct link between what we think and how we elaborate our ideas and cashing profit. This direct link shouldn't be as easy as we might think in the first instance. Okay, let's then start. By the way, let me briefly introduce myself. My name is Gonçalo Moreira. I'm working at backtested since 2008. Initially, I was involved in the education section. I'm the co-author of the Learning Center. I like to say I'm the co-author since other people from our staff were involved in it, heavily involved, like most whom you know well, and also because a big part of the content provided in the Learning Center are direct quotes from our experts, from other people in this industry. And currently I'm covering more advisory tasks in amplifying the services section of the company, as well as strategic partnerships. Okay, we have today more or less 50 minutes and around 40 slides, so we will fly. Fasten our seatbelts and apologize for any grammatical or spelling errors in my English. But I guess it will be an interesting session for all of us. Okay, that's the structure of the webinar. We will do a brief recall on the last webinar. I don't know how many of you were at the last webinar a few weeks ago. I would kindly ask Vicky to post the link for that first webinar in a moment. This webinar will be the follow-up of the last one. The entire series is called the Trading Plan series, and we are covering different aspects of what we consider to be a trading plan. Then we have the core structure of the webinar. We will design a strategy, not only from a conceptual perspective, but we'll go step by step into designing a very simple and yet robust strategy from scratch. And by scratch, I mean we'll start with some of the ideas we presented in the last webinar, where we talked about what we call the inventory. That's our universe of ideas, of observations, and about market behavior, about the industry itself, the trading industry, the trading activity, and from there we will draw a few ideas and design a complete strategy. When I say complete, we will reach the final stage where we verify, where we backtest the strategy and see the results. And to finish the webinar, we will provide links and references and a brief question and answer. Okay, this is the cycle where we start with the ideas. You see, this is a self-nurturing cycle, and we will go through all these steps by drawing a few ideas from the inventory. By the way, Vicky kindly provided us with a link from the last session, from the last webinar. For those of you who haven't seen it, this webinar now will make sense if you see the previous one, where we have dealt only with that first stage we call now the ideas. That's what we called by then with the inventory. There is basically a list where we write down our observations on price action, on market behavior, and from there on we will start to formulate some working hypotheses, and we will move on measuring these hypotheses, and then choosing the tools to measure them, to capitalize on them, and then we'll go into more and more specifics, like choosing the time frame, designing rules and conditions for trade entries and exits and trade management, generally speaking. And as the last stage, we will see a verification process where we backtest and we forward test those ideas, and where we continuously nurture the inventory by the inputs that we get through the verification process. And finally, we reach that target or goal that is accumulating pips. Obviously, there is a monitoring process involved in all the process. We will not cover the monitoring process in this webinar. It will be out of scope. We will do it in future sessions. But then it's a cycle that starts from the beginning. So there is never really a begin and an end when you design strategies. As a definition of a strategy, because sometimes we talk about trading systems, sometimes we talk about trading models, and also we talk about strategies. And the definition of strategy, especially those those who are involved with automated systems, know that the definition of strategy is a set of rules that generate buy and sell signals without any ambiguity. It's a clear signal, and these signals are mostly generated by technical indicators or combinations of technical indicators, what we call rules. These signals may be provided by other techniques. You may get a signal also from a fundamental analysis or any other kind of analysis, more alternative, so to say. But generally speaking, when we speak of signals, we speak of signals provided by technical indicators or combinations of technical indications. The primary aim of a trading system, we would say here strategy, is to manage risk and to increase profitability in a specific instrument and a market environment. So when we speak of a strategy, we speak of one symbol or one currency pair, in our case, in currency trading, and a specific set of rules and a specific for a specific market environment. When these strategies are combined, then we talk about systems, about trading systems. And when the systems are reinforced with money management techniques and so on, then we generally talk about we define it as trading models. So what we'll do today is defining or designing a complete strategy. The inventory, the place where we start, is what we have covered during the last webinar. This is this list where we write down our ideas, observations, beliefs of market behavior and so on. And once you're able to explain how the market works from a personal perspective, since the inventory is really something personal, you can adopt ideas from others. Obviously, our aim is not to be original here, but we can obviously adopt ideas and concepts from here and there. Then you can elaborate an hypothesis or several hypotheses to capitalize on those ideas. Okay, so market observations are thus the building blocks of every system and trading method. And this is really something that, especially in the beginning, when we start out trading, we focus very much on the tools, on the indicators, on the strategies themselves, and we don't bother to see beyond the strategy. If we really believe in the idea that is behind the strategy, because there is always an idea behind. There is always a concept on which we want to capitalize. So if you start to build your system from a truly personal perspective, then there is a bigger chance that the strategy will work for you. Okay, we have seen many cases where someone teaches the ins and outs of a trading strategy to another person, and the other person can't fully execute that strategy, despite of having all the rules very clearly explained. So there must be something. If we can transmit a trading system easily, it's many times because there is a conflict between the rules and our personal market theory, so to say. Okay. Obviously, there are other aspects involved, like our time zone, our personality in terms of risk and so on. Our capitalization level and so on. These are all aspects that would also condition the good performance of a trading system. Okay. So basically, let's take two ideas from our inventory. Let's imagine we have a list of ideas and observations that we continuously feed with new things. An inventory is a living part of our trading plan. It's something that we are currently writing and deleting. So it's really a living part of it. And let's take just two very basic ideas. The first one being, I observe that most daily bars, candles, break the high and or the low of the previous day trading range. Very basic, something very obvious. You would say, well, this is something that everyone sees. That's well, very clear, almost too clear to develop a strategy on it. And the second one, I observe the biggest volatility and price movement occurring during the European and the first half of the American session. Again, something very obvious. There's something that we all have observed. There's nothing original about it. And we would say, well, can we really design a strategy, a profitable strategy, a robust strategy based on something that two facts that everyone sees that are so obvious that, well, there is a difference between something that everyone sees and the way everyone goes to capitalize on it, right? And that's the difference. So the difference is not on the ideas behind the strategy or the hypothesis that we formulate, but the way we design to capitalize on it. Okay, so again, I have selected two very simplistic ideas to show you that you don't have to be original when designing a strategy. Okay, so we see here on a chart the breakouts. This is a daily chart on the sterling dollar, and there is a from this price action that we see here on the left side. There's a zoom on that price action, and we see those dotted lines and the arrows showing the potential breakouts. As we see, there are breakouts occurring all the time. And here we have a chart illustrating the second idea concerning the daytime. So for me personally, working or during daytime GMT, so it suits my training to choose to draw from that observation that during the European session and the first half of the American session there is the biggest volatility. This is obvious an ideal chart that I've chosen. This is a condition that is not always given, but it is more than not the norm. Okay, so just to illustrate these two charts, were just to illustrate the two ideas. So from those two first ideas, we start to formulate our hypothesis. Okay, so the magnitude of the breakout differs from candle to candle, but many times the distance price shoots off the previous daily extreme is large enough to be considered a profit potential. Therefore, I want to capitalize on the breakout. Okay, I established the hypothesis, and I am clear about what I want to capitalize based on those observations. Okay, so preparing the hypothesis requires you to actually see on the chart if there is enough evidence that a specific action-reaction pattern regularly happens. Okay, nothing more involved. At this stage, we are just observing and formulating hypotheses. We are not basing our strategy on a tool, on a system, on a technique. We are really starting from scratch. We are starting from our observation. Okay, so the tool here is something secondary. Okay, so once we have seen those breakouts and we see that there is a potential in the magnitude of the breakouts, so once we have enough evidence that the recurring action-reaction event, in this case a breakout, takes place on a regular basis, then you can measure that potential. For example, let's take 2005. This was more or less when I started developing the strategy that we are going to see. During 2005, the average magnitude of the breakout, okay, was 65 pips in the sterling. Okay, 65 pips. So measuring all the breakouts, taking all the breakouts during 1 year and measuring them, an average would give a breakout of, or a magnitude of 65 pips in the sterling. Okay, 92% of those breakouts were above 10 pips. It means that more or less 8% were small, tiny breakouts of less than 10 pips. Okay, and 92 above 10. Then we start to to fragment all these to go step by step to measure how many times we had a breakout of 20 pips, 30 pips, 40 pips, and so on. Then we get to our average magnitude of 65 pips, and that occurred around 38% of the time. Okay, 38% of the time. It's not a huge percentage, but 38% of the time we get that average magnitude. Okay, but very encouraging to see that 19% of the time those breakouts, okay, of the previous high or previous day low were above 100 pips, almost 20% above 100 pips. So that's interesting enough as the measuring of my hypothesis. Okay, so I start to measure it. Okay, just go on the chart, and I don't take any signals, any textbook indicator signal. No, I just measure the magnitude of the price action, and I also measure the frequency. Okay, so I see in that case during 2005 the sterling broke out 88% of the time that year. Okay, I don't want to capitalize on an event that occurs only 3 times a year. Okay, so what happens if you are in the toilet during that event happening? Then you have to wait for the next signal. So you want something that happens frequently, so that a loss of opportunity, since a loss of opportunity is an implicit cost in trading. Okay, we have explicit costs like spreads and the swaps, the rollovers, and so commissions and so on. And we have implicit costs. These may be delays, it may be requotes, and so on. And also the loss of opportunity. You are not at the trading desk when an opportunity occurs. Okay, so I want something that happens with a certain frequency. Okay, 88% of the trading days I have a breakout. Okay, fairly interesting, the data. So once we have measured, okay, so we have established our hypothesis, and we have measured it. Okay, we are now at this orange stage here in the cycle. Okay, so we go further, and we start to think about the tools we want to use to capitalize on those measurements that we did. Okay, so the market conditions that are to be met in order to capture this event are an increased momentum and volatility in the market. Okay, so breakouts are associated with these qualities of momentum, of volatility. So here is at this stage where I think about the tool, already it is required a certain know-how about the tools. Okay, about the nature of the technical indicators. In this case, we are going to use technical indicators on. Okay, so it's not necessary to know about dozens or hundreds of indicators. If you know the classic ones, and if you know them well, if you know what were the ideas behind the creation of those indicators, then you will be able also to choose them properly. Okay, so if you want to capitalize on a breakout, you know that a breakout is associated with certain momentum. You need momentum to capitalize on a breakout, and you need also a surge in volatility, because we are capitalizing on breakouts of previous day highs and lows. So we are not entering probably the trade at or the movement at its start. So we need momentum, we need volatility to catch that average of 65 pips. Okay, and also a major underlying trend in the direction of the breakout. So we need that trend following characteristic for the breakout. Okay, so when we start to think about the tools, we are searching for tools that are usually used in trend following or that provide us with information about the underlying trend, the trend direction, and as well as momentum and volatility. Okay, so far so well. Are you following me well? Is it clear the idea? How we started from our ideas, how we went on to measure them, and now we start to look for the tools. Okay, great. Thank you very much. So another element of the trading strategy is the time frame, obviously. So it's advisable here to experiment with different time intervals, because an hypothesis may work better on a small time frame than in a longer one, or vice versa. Okay. In our case, on one hand, the 4-hour time interval seems too high to visualize the smaller breakout. Okay, so remember that average of 65 pips. Now imagine a sterling dollar 4-hour chart. It may be a little bit difficult to visualize clearly those small breakouts. And on the other hand, any time frame below 1 hour may generate unnecessary signals. Okay, the decision about the time frame is something that is not evident from the beginning. It's not something that you say, well, I choose that time frame and that's it. That will be the time frame. No, the process that we are seeing here, like a cyclical one, there is made of smaller cycles where I go from the very fine of the testing phases. I go back into again to the idea world, okay, to the idea stage, and then I nurture again and again. So it's a cycle made of several small inner circles that feed and provide momentum to the bigger one. Okay, so but I had to in order to explain it to you, I had to put it in on a linear form. But it's something that you go forth and back, but always with the idea to gain momentum in the design, whole process of the system design. Okay, so referring or concerning the time frame, the time zone used for testing will be GMT as a standardized time zone for the Forex market. Again, this is something that I found out when testing. Okay, the tools that I finally chose were working better on a GMT chart, so that's why I choose it. But again, this is something that you might not see it clear in the beginning, but that you realize when you start testing the tools you have chosen. Okay, so the pieces of a strategy, any objective trading method should encompass several functions in order to capitalize on a hypothesis. Its basic setup should provide specific rules for determining, developing trends, reversals, or ranges, short, intermediate, and long. In our case, we need a tool that determines a developing trend, since a breakout in our case hasn't nothing to do with reversals or range trading. We want a tool that tells me about the developing trend, the direction of the movement. Okay, if it is upwards, if it's downwards or sideways, I want to know the direction, because the breakout has a direction. It can be up or down. So I want a rule in my system, a tool or a combination of tools that provides me a clue as for direction. And then I want to have also exit levels to avoid large losses and exit levels to take profit on favorable positions. Okay, and obviously I want to adopt also or to find out the optimal time to be in the market. Okay, these are the pieces of this strategy. So then I start the first round of tests. I start testing. I start pulling some indicators on the chart. I start adjusting the settings, the time frames, and I start experimenting. Okay, at this stage I'm experimenting, but I'm experimenting with this idea in mind, with these measures that I took initially. I know the potential of the breakout. I know the frequency of the breakout. So when I start the first round of tests, I want to get close to that maximum favorable excursion of the of the breakout, and I want to get close to that frequency of 88% of the time. Okay. Obviously, we will filter many of those breakouts. We will filter them. We will catch only those breakouts with a bigger potential. But still, I want to get as close as I can to these first measures. So this is always with this idea in mind. I start to experiment, and you see the experimentation process. It's not something that you just go around and today you test an indicator, and then you visit a forum and you see another, and you download here a set of indicators, and you keep going on and on and on and testing, or just experimenting with indicators with no idea in the back of your mind. So then you will become very proficient in using or knowing the names of the indicators and where to find them, but not much more than that. Okay. So personally, I've been trading Forex for around 7 years, and I only know the most basic indicators. So if you come to me with the complex ones, I probably never heard about them. But from the beginning, I wasn't really interested. I had my time where I started searching here and there for indicators, but I saw that there are trillions of indicators, so it's easy to get mad. So again, these optimal levels of risk and reward are accomplished by modifying the different parameters within each rule of the system. You start to modify parameters in the indicators and writing down possible rules to capitalize on those breakouts. Okay, it's recommended to start with a backtest. Okay, if not possible, then obviously you choose a forward test. Okay, very briefly, the difference between a backtest and a forward test is backtest is on historical data. You just go back in time and you simulate the trading based on historical data, and a forward test is done with current present data. Okay, the difference is basically one of speed, because in forward testing you are tied to the time dimension. 60 minutes is 60 minutes. You can't accelerate it, but when you are back testing, you can accelerate. You can make a 60-minute candle develop in 1 minute or less. So you gain a lot of experience in that side. There is an argument against backtesting many times, and that is because there isn't that emotional part of the trading is really there when you backtest. But you see, at this stage, you don't need the psychology at this stage. We are testing an idea. We are seeing if my ideas and the way I measure them, the way I try to capitalize on them, fit the market behavior. I mean, at this stage, I can be a master of my emotions, but if I haven't done this test, all the emotional control and what this will be for nothing. Okay, so backtest has this purpose and nothing more. It doesn't aim to replace real trading, because we are, you see, we are many steps away from real trading. This is what we are doing today is one webinar of a complete series of the trading plan, and there will be many stages. Yeah, okay, and we are just seeing one stage. Okay, to the design of a strategy. So and backtest is only a small part of that stage. So you see the place that backtesting occupies. It's a small place in your overall career. It's a small place, but it's essential. It's an essential place. If not possible to backtest, then you forward test. There are some strategies that, well, depend on signals, on indications that are not technically provided. Can work based on, you can trade on news and so on, and it makes it a bit more difficult to backtest it, since news trading, for instance, is very dependent or very sensible for spreads, liquidity, market liquidity. So there are some strategies that, and especially when you get to more discretionary strategies where the rules are not 100% mechanical, then you probably need to forward test. Okay, but then you have to have in mind that you will need more time. Okay, but if you are testing a system that, especially in higher time frames, to 240 minutes and above, please backtest. Don't spend 1 year forward testing a strategy just to say after 1 year, I need to change my parameters of the MECD. I mean, then you will need 10 years to design a strategy. And after 10 years, maybe that currency pair doesn't exist anymore. So, if you have the chance to backtest, you should do it. There is someone from our experts who has done several webinars on backtesting, Trif Hammond. Okay, if you haven't seen any webinars from her, please visit the archived webinars from Trifany. She is a proficient backtester and trader and coacher, and it's great information what you get from her webinars. At the end of the session, I'll provide you some links to her one of her recent webinars as well. Okay, so from this testing, new observations arise while you are testing, because there are some observations that you only get when you are backtesting. Why? Because when you are backtesting, you are executing a certain set of rules, right? And while in real time, you have to wait so long between each signal that there is a lot of information going through your head, yeah, and it dissipates your original observation. Okay, you have to have really a capacity of abstraction to keep with the essential. And while you are backtesting, there is a lot of speed, and you have no information. You have no news, no media, and no other indicators. Just your pair and your tools, and the information you get is price information. So from backtesting, a lot of information arise, and you will see some of the rules of the system are very accurate, and that is because I went through many years of backtesting. Okay, so a new observation on this system would be that the magnitude of the breakouts are many times 161.8% Fibonacci extension of the previous day range. Therefore, the Fibonacci scale is the tool for measuring my target. Okay, this is something that while backtesting I observed. If you anchor a Fibonacci expansion tool from the low and high of the previous day, you get this 1618 extension, and many times the breakout is done within a few hourly candles and goes towards this target. Okay, so here again we already have some tools on our chart. Okay, following tools will be used to create the conditions and rules of the strategy. First, a price box will be used to mark off the high and the low prices of the previous day. It will be displayed on a 1 hour chart, and each 24-hour period it will be marked with a vertical line to distinguish the start and the end of the day. Most platforms have that period separator. Okay, and a combination of two moving averages will help to get the direction of the underlying trend. Okay, this will be 21 and the 89 simple moving averages, two numbers taken from the Fibonacci sequence, which are not contiguous. You see the Fibonacci sequence 5, 8, 13, 21. We choose the 21, 34, 55, 89. We choose the 89, and so on. The 21 we choose also because it's the center line of the Bollinger Band, and again it's an indicator that is commonly used. So I wanted to have it on the chart. So here you see we start already to plot indicators on the chart. Bollinger Band applied to the 21 simple moving average will be used as an indicator for volatility. These Bollinger Bands contain around 95% of the closing prices. So price action will be confined between those moving averages. The higher the standard deviation used in the setting, the more closing prices are contained within the band. As the breakout movement needs to be aligned with the main trend, we need a parameter that gives some room for price to develop. Therefore, the deviation will be initially set to 3. Correct. Yeah, the middle band of the middle average of the Bollinger Band is a 21. It's set to 21 period and 3 standard deviation. 3 standard deviation in order to encompass more than 25. I think it's around 27% of price action. Okay. Fine. So again, I have the rules, and I know the reasons why I use them, because previously I studied a little bit. I studied a little bit of the nature of the indicators, what they are used for. So I start to write the rules. Okay, the parameters to enter positions will be related to the type of system, whether it is trend following system, a breakout system, etc. The trade entry must be described in detail, including concrete definitions of the proper market conditions for entry and the final confirmation signal, also known as the trigger. So you want to have those conditions where you say, I have green light to go long, or I have green light to go short, and then you want to have the confirmation signal, what we call the trigger. Okay, so sometimes we do not base our decisions on a signal, on an indicator signal, but a combination of indicator signal or conditions. A certain indicator is at a certain value, or has a certain degree, or has a certain shape, and so on and so on. And then we need obviously that final trigger. How many years of backtested do you recommend for someone wanting to trade a 4-hour chart? Well, it will depend on the frequency, right? On the frequency of your signal. If you have, I would rather say, instead of years, I would say if the first test start to gather numbers of 50 trades, okay, just to see how the indicators, the settings react to your original idea. You modify them, you choose another market condition and test again 50 trades, and so on. And then when the strategy is maturing, then you want to test several years, because then you want to test different market conditions. Okay, it's not the same when I started to design this system. 2005, the market behavior was very different to 2006, 2005 were more or less. But then in 2007, it changed. 2008, 2009, every year we got different behavior. Okay, so I would rather say the number of trades more than the time. But then again, test that strategy in different market conditions. Okay. So let's move on here. So we are just to recall here where we are. So we would be here, right here in our brown. Around here, where we say rules and conditions. So we have in front of us still the verification phase, and then the pips gaining. Okay. So here are some details about the strategy here. We see on the left side, we see the upper Bollinger Band is expanding when the exchange rate breaks the high of the previous day. This is a favorable signal to go long. Okay. And on the right side of the chart, the upper Bollinger Band is contracting, it's shrinking. This is not a favorable signal to go long. And you see how the price pierced the high of yesterday's yesterday's high. It pierced it twice, but we didn't took that as a favorable signal. Did I jump one? Let me see. These were the slide where we were the entry rules. Okay, market conditions for entry and confirmation signal. Then we had the cycle. Okay, we are now at the rules and conditions. We move on to the verification, and these are the first rules and filters for the entry. So entry rules will be long entry conditions are the SM1, the 21 SMA is above the 89 SMA. Okay, we have trend and direction. Okay, we have that indication for developing trend and direction. Something very, very basic. The faster moving average is above the slower one. This indicates an uptrend. And the upper Bollinger Band is not shrinking or pointing to the downside in the previous candle, previous to the signal breakout candle. Okay. Specifics about the system are written in the Learning Center in Unit C. So I will go quite fast here, just as a means of an example. Okay. So the long entry trigger is the exchange rate breaks above the high of the previous day. Okay, that is our trigger, the break. So we would use probably stop orders to enter our position. So since you know already the level. Okay, we would wait for all the conditions signaling a green light, and then we would place our order. Adjust the entry level to the previous day high, adding 1 pip in the spread to the upside. Just as a means of caution, we would go a little bit above with the spread and more or less 1 pip above, just to avoid those piercings and false tiny breakouts. Okay, the high of the previous day we have here. A breakout. Okay, we see how in that chart the previous candle to the breakout is this one, and this candle already made the Bollinger Band here expanding, signaling that there is an increasing volatility in the market. So you see moving averages are lined up to the upside. So we took the breakout. This is a valid breakout. Okay, the exit rules. For the exit rules, there are two types of exits: a stop loss to get out of a losing trade, and a profit target to realize profit when the market moves in our favor. Okay, and here we adopt the Fibonacci extension tools. In the way the tool is anchored in the chart here is by anchoring the 0% level on the opposite side of yesterday's range. So the 100% of the Fibonacci scale would be the high, in that case the low of yesterday's price. Okay, so that we have that extension 1618% extension that would be our target then. Okay, there is only one target in this strategy, and this is the Fibonacci extension 1618%. The exact take profit order will be placed a few pips before the 1618 level. If there is a round number closer than 10 pips to that level, take the round number as a target. Okay, this is also something that I've added here to the exit rules. This is something that probably you don't write in, you don't establish as a starting point in your exit rules. But once you start testing, you find out that some tiny changes have to be made to your targets and so on, based on observation. Abel is asking, do you mean price has to close above the previous day high, or is it enough for it to just touch it? We want a breakout. That is, we want price. We take the trade during the breakout. We don't wait for a candle to break beyond the yesterday's high or low, but we take with a stop order, we take the breakout. Okay, we provide a few pips distance from the yesterday's high or low, but we enter the trade in the fly, so to say, because we already have several conditions pointing to that condition, so we don't need to wait for a close. Okay. Besides, during testing, I've seen that many times on the 60-minute chart, the target, 1619 target, is reached within one or two candles. So that's why we don't want to wait for a close. But we have filters. We have added filters, obviously, to the system. Okay. So the stop losses. The stop loss on a long trade is placed below the 21 SMA or the 61.1% or 38.2 Fibonacci level. That is from let's say we are going long. That is a retracement of 38.2% retracement, or the 21 SMA. Whichever is close to the entry price, there we put our stop. Okay. Conversely, the stop loss on a short trade is placed above the 21 or the 618% or 38.2. This will depend on how you anchor your Fibonacci. But in real terms, it's 38.2 distance of the entry price. Okay. This way, once you have this rule in place and your stop is at a 38.2% distance from the breakout level, and your target is at 1618%, then on every trade you the win-loss potential, the win-loss ratio potential on every trade is a fee ratio. Okay, it's always 1 to 1618%. Currently, okay, this is not a win-loss ratio of 2 to 1 or 3 to 1. It's much lower than that, but still it's a robust system, like we will see in the results. Okay, we'll stop in 2 minutes. Let's jump here some slides. Here we have the results for 5 years of backtesting between 2009 2005 and 2009. We see the equity curve and some statistics here displayed. And this equity curve is basically done using a fixed lot size. Okay, fixed lot. I traded always the same lot size, and the return rate is more or less 295%. We grew an account from 2,000 almost to $8,000. Okay, and we are here at the verification phase. Okay, and so we want we keep going on and fine tuning the system. Okay, we have several other observations which we feed the strategy with. I know I've missed the slide. I've jumped the slide, and we have only 2 minutes left. I'm sorry. And here we have we include the position sizing to the system, and we see instead of a fixed lot position sizing, we have played here with a measured fixed fractional, and we see how we could grow a $2,000 account to above 20,000. Exactly the same trade. Okay, adopting a different position sizing technique, and another one, fixed ratio position sizing, grows an account from 2,000 almost to $90,000. Okay, exactly the same trade. Okay, exactly the same rules and all the same. I just changed the position sizing. Okay, I show the position sizing here just as a means for you to know that we will cover this aspect in a future webinar. For today, the idea was to understand that the ideas behind the strategy, or only by understanding that the ideas behind the strategy, you will be able to effectively use it to your advantage. We have also learned that the closest thing to a holy grail in trading is building a trading method based on your own inventory, as we have defined it in the last webinar. And we have also learned not to be too picky trying to find or develop the miraculous system. It's not needed. You see how a very mechanic strategy grew an account from 2,000 to almost 90,000, 5 years in one pair, in one time frame. And we have also learned that no system is 100% accurate. All we need statistically is a legitimate edge. Here are some links provided by Vicky. Thank you very much. And there are some lessons to be learned. We will talk about position sizing. We'll talk about monitoring techniques, trade log, trade statements, statistical figures, trade journal, accountability partner, and so on and so on. And a final note, we'll go from mechanical trading to discretionary trading all along this webinar series called the Trading Plan Series. Thank you very much for your attention, for your time. It's nice to be with you. Sorry that we haven't had time for a question and answer session. I may repeat this webinar in a future date, so we can discuss about it. And I may also include part of it for the next one. All right. Thank you very much again, and have a nice week. And bye bye. Take care.